Hi, it's Jeff Vogan with Premier Retirement Planning and Wealth Management. Welcome again to another Tip Tuesday. We hope you're having a good month. I don't know if you've heard, but boy, with all the Facebook and social media things going out there, I think you probably know by now, this is Life Insurance Awareness Month. Now, why do they have a Life Insurance Awareness Month? I'm not really sure, but I think it's great for the industry. It's also great for you as a person to kind of reflect on whether or not you even need life insurance. Now, keep in mind, I have two definitions of life insurance. There's the kind that you buy because you want to live and use it, and there's also the kind you want to buy so that if you end up dying, you get to leave somebody well off, somebody you care about. That I call death insurance. It really should be called death insurance, really, because you're insuring your death. Now, if you want to insure your death because you have somebody to care for after you're gone, then I think that's great. Many people find that buying term and investing the difference is the smarter way to go, because you may only have that obligation to get those kids through college for the next 20 years, to get that wife, that you might leave behind, or the spouse you might leave behind, the husband you might leave behind. Maybe just give them enough to give them time to get remarried or reestablish someplace. Whatever your goal is, it may be the death insurance part may be kind of the less important part of life insurance. I want to just remind you that life insurance has some great benefits if you use what's called cash value life insurance. If you use what we call permanent life insurance, we can do it through whole life, which I personally don't like because the costs are more expensive. It's too rigid and you don't have flexibility. I really like the indexed universal life programs out there where you can invest in a bucket and not buy it for the life insurance, not buy it for the death benefit. You can actually use life insurance just as a tax haven or a tax efficient place to save money and grow it at a rate much higher than other safe places. Now keep in mind, safe fixed products, fixed insurance like indexed universal life, which is fixed, meaning it's guaranteed as far as the principal goes. The only costs you really have are any front-end loads, which might happen while you fund the policy, and also the cost of insurance. And you might say, well, what are those fees? Well, for most people, depending on how you structure it, could be anywhere from 1/4 to 0.5%, maybe up to 1 or 2%. Well, that's what you're paying on a mutual fund portfolio anyway. The difference is now you're getting tax-free growth, and you can get tax-free growth in many cases better than a balanced stock and bond portfolio. Some of these index products have caps, meaning that you can make up to 10 or 12 or even more percent per year with no chance of losing your money. So life insurance awareness is not just about the death insurance part. It should be aware of some of the opportunities to make money safely in a tax-free or a tax-advantaged environment. Certainly better than CDs at 1 or 2%, certainly better than money market at 0 or 0.1%, certainly better than the bonds. Now the safe bond market, the treasuries are down below 2%, 1%, short-term bonds paying less than 1% for a portfolio of short-term treasuries. I mean, that's ridiculous. Long bonds, 2.5%. The only way to get better interest is buy junk bonds, which have a high probability of default, whereas the insurance companies take that risk and they don't give you that probability of default and yet pay a higher rate of interest. I don't know if it sounds like I'm rambling or jumping around a little bit, but there's a lot of benefits to make good, solid rates of return in a tax-free environment. Kind of like putting money away in a Roth, but a Roth on steroids. And the cool thing about life insurance, the life insurance portion, the permanent life insurance where you get benefits while you live, is that money can grow tax-free. You can take it out prior to age 59 and a half. You don't have to wait like on an IRA or a Roth IRA to wait till after you're 59 and a half to take your money out and use it. You can use it beforehand. You can actually borrow against the cash value of the policy tax-free to pay for down payments on a house, to send kids to college, to do other things you don't have to die for. In other words, you can get the benefits while you live, not just because you die. So keep in mind, Life Insurance Awareness Month isn't just thinking about your death, isn't just thinking about, oh, what happens, what am I going to leave, what mess am I going to have to solve a problem for if I check out early. It's a lot about, hey, how can I structure my investment portfolio to generate consistent growth, safe growth, create some income for the future, and create a tax haven or a tax efficient place to park money that you can use at any time for any reason. So don't forget life insurance part of the death insurance equation. Give us a call if you have any questions. We'd love to help you. It's a great time to just review all your options. September's Life Insurance Awareness Month. Now that you're aware, do something about it. That's my tip of the week. See you next time.